All right, let's talk Columbia Banking System, ticker COLB. Their fourth quarter earnings report just dropped, and on the surface, it looked like a home run. I mean, they blew past analyst estimates. But then, the stock fell. So what gives? What did the market see that the headlines completely missed? That's what we're going to dig into today. Let's get to it.
Okay, here's how we're going to break this down. First, we'll tackle that weird earnings paradox. Then we'll deconstruct the Q4 beat to see what's really under the hood. After that, we'll get into the Pacific Premier story, which is a huge deal for them. We'll look at the guidance they gave, and finally, I'll give you our take for the next call.
All right, let's dive into Section 1, the earnings paradox. You see this happen all the time on Wall Street, right? A company puts out what seems like fantastic news, a real strong beat, but the stock just tanks. It's the perfect reminder that you've always got to read past the headlines.
And wow, look at this. The difference is just night and day. On one side, you've got this awesome beat. Operating EPS was 82 cents, when the street was only looking for around 71 cents. That's huge. And revenue? Also a solid beat. But then you look at the other side, the market's reaction. The stock dropped about 2% right away in after hours. Total disconnect.
So that's the big question, isn't it? On paper, the quarter was a smashing success. So why the disconnect? Why are people selling on what looks like good news? Well, to figure that out, we've got to dig a little deeper.
Okay, on to Section 2. Let's actually deconstruct that Q4 beat. See, these days, the market is obsessed with something called earnings quality. It's not just about hitting a number, it's about how you hit that number, and more importantly, can you do it again next quarter? So let's start with that big, flashy number everyone saw, 82 cents per share. And yeah, by itself, it looks fantastic. A 15% beat. That's the kind of thing that gets headlines written. And it's not just that. Their profitability looked really strong too. You're looking at a return on tangible common equity, or ROTCE, of over 15%. For a bank, that is a very solid number. So everything looks great, right? Well, here's the catch. Okay, this is where we find the smoking gun. Their net interest income, or NII, looked really good, but it got a little help, a temporary $12 million boost from something called premium amortization. Basically, think of it as a short-term accounting perk from their big acquisition of Pacific Premier. But the key word here is temporary. That little boost is gone now. It's not coming back. And that's what smart investors noticed. They looked right past the big number, saw this one-time goodie, and thought, maybe the core earnings aren't quite as strong as they look. And that brings us right to the main event. The real story for Columbia Bank right now. The Pacific Premier acquisition. Honestly, you can forget about the weird one-time items in Q4. For anyone in this for the long haul, and definitely for the management team, there's only one thing that matters: nailing this integration perfectly.
And look, management has a very clear game plan here. They've laid it all out. They've already locked in $63 million in cost savings, so check that box. The next big hurdle, and it's a huge one, is the systems conversion happening this quarter. From there, the goal is to get to a nice, clean, predictable expense number by the third quarter of 26 and hit that final target of $127 million in total synergies. That's the promise.
And they're sounding pretty confident about it. You can see here, CEO Clint Stein basically said, "We got this." He talked up his team's experience, their planning, everything you want to hear. But make no mistake, this systems conversion is the critical test. There's just no room for error here.
All right, Section 4. Let's talk guidance. After a kind of noisy quarter like the one they just had, what management says about the future is everything. This is where everyone's looking for clues about where the ship is really headed.
And yep, management's own forecast basically tells the story. They're telling us to expect net interest margin, that's a super important profitability metric, to take a dip in Q1. It's going to drop from that 4.06% down to the low 3.9s. And why? Exactly. It's that $12 million one-time benefit, poof, gone. This right here confirms that short-term pressure we were talking about.
But here's the thing, it's not all doom and gloom. They're not expecting that dip to last. They see the margin bouncing back pretty quickly and climbing back over 4% later in the year. Now, loan growth is going to be kind of flat, but that's on purpose. They're focusing on quality over quantity. And this is a big one. They plan on buying back a ton of their own stock, between 150 to 200 million a quarter. That's a huge vote of confidence from the inside.
Okay, time to put it all together. Our final section, the next call. What's our take? Let's boil all this down into what really matters going forward.
So if you're following COLB, this is basically your roadmap for the next few quarters. Thing 1, that systems conversion has to go off without a hitch. Absolutely critical. Then, we need to see proof that their net interest margin is bouncing back, just like they said it would. Keep an eye on those share buybacks, too. They need to be consistent. And finally, by Q3, we want to see that clean expense number. That's the signal that the integration is really, truly done.
So, what's our prediction for the next earnings call? Honestly, don't expect fireworks on the headline numbers. Q1 is probably going to look a little quiet. The real story isn't going to be about some massive earnings beat. It's going to be all about one word: execution. We'll be looking for proof that they're hitting all those integration milestones right on schedule.
And what does that mean for the stock price? Well, our best guess is that it'll probably chop around in a range for a while. The stock's likely stuck in neutral until the market sees what it's waiting for: cold, hard proof that the integration worked and that the company's earnings power is real and sustainable.
So putting all that together, a rating on Columbia banking system is market perform. Look, the long-term potential here is really interesting, and management's plan seems solid. But you've got that short-term pressure on margins, and this is very much a show-me story right now. We just can't go to an outperform rating until we see the proof. It's all about execution.
And as always, remember, this is not financial advice.